coming to the last part, what is the role of central bank? Generally, a central bank is the monopoly supplier of the currency, the banker to the government and the banker's bank, the lender of last resort, the regulator and supervisor of the payments system, the conductor of monetary policy, and the supervisor of the banking system. Central banks are usually responsible for the operation of a country's monetary policy. They are also responsible for maintaining price stability, thereby keeping inflation under check. Various tools used by the central banks for the same include open market operations. For example, when the central bank buys government bonds from commercial banks, this increases the reserves of private sector banks on the asset side of their balance sheets. Banks use these surplus reserves by increasing lending to corporations and households. Repurchase agreements. For example, if the central bank wishes to increase the supply of money, it might buy bonds, usually government bonds, from the banks, with an agreement to sell them back at some time in the future. This transaction is known as a repurchase agreement. Base rates. For example, large corporate clients might pay the base rate plus 1% on their borrowing from a bank, while the same bank might lend money to a small corporate client at the base rate plus 3%. Thus premium on base rate is charged depending upon the financial position of the client, creditworthiness, liquidity position, size of load, etc. Generally, commercial banks do not immediately increase or decrease their base or reference rates when central bank changes them. Thus this creates a lag in the operations or transmissions of the monetary policy. And the last one is reserve requirements. If a central bank increases the reserve requirements, a bank that was short on reserves might have to cease its lending activities until it had built up the necessary reserves. Thus, as a result, central banks can maintain the liquidity in the economy with the help of this. The above all made the understandings in simple terms, while there may be broad implications of each of these steps. However, there may also be several impediments to the successful operation of monetary policy in developing countries, which may include the absence of a sufficiently liquid government bond market, a rapidly changing economy, making it difficult to own the equilibrium relationship between monetary aggregates and the real economy, a poor track record in controlling inflation in the past, an unwillingness of governments to grant genuine independence to the central bank. So that was all about role of central bank as well as business cycles at large. This fundamental will help you understand the upcoming videos in a more efficient and in-depth. Before we discuss what's going to be in the next episode, please don't forget to like and share this video as well as subscribe to our YouTube channel. It would mean a lot to us. In the coming episode we will be discussing about the current global economic situation across the globe on account of this epidemic and how it has crippled the world economy by disruption the entire supply and demand chains. Till then, stay tuned and do not forget to hit the bell icon to get notified when we upload a new video. Thank you.